Have you ever noticed that sometimes playing it safe in the stock market can actually make you more money than chasing the next hot pick? This quarter, right before the big wave of Q3 earnings, I decided to take that approach, and it paid off. Over $7,000 in profit, all from option trading. Nothing crazy, no day trading, just consistent strategies, selling cash-secured puts, covered calls, and holding long LEAP options when the timing is right. Now, before we get into the details, this video is for educational purposes only, not financial advice. I'm just sharing what worked for me, and hopefully it helps you find your own rhythm in trading. And if you enjoy learning about real investing results and strategy, make sure to hit that like button and subscribe. It really helps me keep sharing content like this. All right, let's talk about how it all unfolded. Heading into Q3 earnings, volatility was picking up. Stocks like Meta, Amazon, and AMD were moving fast, and the option premiums were juicy. That's when I decided to position my portfolio more defensively, not by guessing earnings outcomes, but by managing risk through options. The biggest win of the quarter actually came from Meta, but not by holding it. A few weeks before Meta's earnings, I decided to sell my long call LEAP on Meta. I had held that option for months, and it was sitting at a decent gain. But as the earnings date got closer, implied volatility was climbing fast. That means option prices were inflated. Perfect time to sell. And that move saved me from what could have been a painful hit. Meta's earnings were solid, but the market didn't love the forward guidance. If I had held through the event, I could have seen my position drop by around $4,000. Instead, I locked in my gains early, and then immediately rotated that capital into something new, Amazon. That decision turned out perfectly. Right after Meta's earnings, I bought a long-term LEAP option on Amazon, betting on their long-term AI and cloud growth story. Within days after Amazon's own earnings report, that position was already up over $2,000. That's how I managed to turn a potential $4,000 loss into a $2,000 win, just by timing my entries and exits around earnings risk. But Amazon didn't just win on the LEAP side. It also helped me on the cash-secured put strategy. I sold a long-term put option on Amazon before the earnings report at a strike price that I felt comfortable owning the shares. My rule of thumb is simple. I only sell puts on companies I wouldn't mind holding long-term, even if they get assigned. After earnings, Amazon shares jumped, and that put option's value dropped sharply, meaning my position had an unrealized gain of more than $1,000. I haven't closed it yet, but it's already showing solid profits. This is one of my favorite plays, selling puts on quality stocks during volatile times. I collect premium up front, stay protected by cash, and let time do the work. Then there's AMD, another strong performer, but this one's from the covered call side. I hold 100 shares of AMD, and I sold 2 covered calls right before earnings. For these trades, I use a very conservative rule. I always set the strike price about 20% above the current market price, with expiration roughly 2 weeks out. Why 20%? Because it's high enough that the stock has plenty of room to move without my shares getting called away. My goal isn't to trade away my AMD. I want to hold it for years, maybe even watch it climb towards $600 one day. By setting that strike buffer, I can safely collect premiums while still keeping my long-term position intact. Those 2 covered calls brought in around $400 in total. Not a huge number compared to the LEAPs or cash-secured puts, but the key here is consistency. Every premium adds up, and when you do this over and over, it's almost like creating your own dividend income. Now, outside of those main trades, I've also been rotating through other familiar names: Tesla, Nvidia, Palantir, Apple, and SoFi. These are companies I like long-term, but I've been playing them cautiously. When I sell puts, I usually go with conservative strike prices, typically around 10 to 15% below current levels. That means smaller premiums, but also much lower risk of assignment. Here's how that helps. By staying conservative, I can keep my cash liquid. I don't want to get assigned shares on every position. That would tie up too much capital. Instead, I collect smaller premiums across multiple trades, and because those options usually expire worthless, I can immediately recycle that cash into new positions. It's like keeping the engine running all the time, never idle. One rule I've learned the hard way: always take profits early. If an option reaches around 80% of its maximum profit before expiration, I usually close it right away. The last 20% of premium isn't worth the risk of sudden market reversals. By closing early, I lock in the gain and free up capital to open new trades. That flexibility has been a big reason why my overall return stays steady month after month. Option trading isn't about hitting home runs every time. It's about managing probabilities. Selling puts, covered calls, and LEAPS, they each have their role. Leaps let me participate in long-term upside without tying up too much cash. Cash-secured puts generate steady income while positioning me to buy quality stocks at lower prices, and covered calls create extra yield from the shares I already own. The magic happens when you blend them together, adjusting position sizes, expiration dates, and strike distances based on market mood. Before earnings, implied volatility spikes, which means option premiums rise. That's when I prefer to be a seller, not a buyer. I can collect more premium for the same level of risk, and right after earnings, when volatility drops, I look for opportunities to enter new leaps, because option prices are temporarily cheaper. That's exactly what happened this quarter. By timing my trades around those volatility swings, I made more than $7,000 in realized and unrealized gains without taking oversized risks. I didn't buy weekly lotto calls or gamble on binary earnings outcomes. I just used structure, discipline, and timing. Looking ahead, I plan to keep the same approach. The market's still full of opportunities, especially with big names like Nvidia and Tesla showing strong long-term growth trends. But the lesson from this quarter is simple. You don't need to predict the market to profit from it. You just need to manage your positions, stay patient, and know when to collect gains. So that's how my option strategy played out before Q3 earnings. Cash-secured puts for steady income, covered calls for extra yield, and long leaps for growth exposure. Together, they helped me lock in more than $7,000 while keeping risk under control. If you enjoyed this breakdown and want to see my next round of option trades or updates on how these positions evolve, don't forget to hit that like button and subscribe. I post real stories, real strategies, and transparent results. No hype, just smart trading. Thanks for watching, and I'll see you in the next one.